So the financial position of Moore Limited on the 1st of the 1st, 2010 is shown in the following balance sheet. So there you see all the list of assets and liabilities. The following transactions took place during 2010. So January, Moore Limited decided to revalue land and buildings at €700,000, which includes land valued at €90,000 on the 1st of the 1st, 2010. In February, Moore Limited bought an adjoining business on the 1st of the 2nd, 2010, which included buildings €200,000, equipment €30,000, debtors €8,000 and creditors €40,000. The purchase price was discharged by granting the seller 180,000 shares in Moore Limited at a premium of 20 cents per share. In April, management decided that the provision for bad debts should be raised to 7% of debtors. In May, a vehicle which cost €25,000 was traded in against a new vehicle costing €35,000. An allowance of €20,000 was made for the old vehicle. Depreciation to date on the old vehicle was €5,500. In June, received a bank statement on June 30th showing a credit transfer received of €4,500 to cover 9 months' rent in advance from June 1st and a direct debit of €1,500 to cover advertising for the year ended 31st of the 3rd, 2010. In July, a payment of €720 was received from J. Murphy, a debtor whose debt had been previously written off and who wishes to trade with Moore Limited again. This represents 80% of the original debt, and the debtor had undertaken to pay the remainder of the debt by February 2011. On the same day, goods to the value of €440 were sold on credit to Murphy. In August, goods previously sold for €600 were returned. The selling price of these goods was cost plus 20%. A credit note was issued showing a deduction of 5% of the selling price as a restocking charge. In September, a creditor who was owed €800 by Moore Limited accepted equipment, the book value of which was €700 in full settlement of the debt. The equipment cost €1,200. In October, a dividend of 5 cents per share was paid on all issued shares. In November, received €100,000 from the issue of the remaining shares. In December, the building's depreciation charge for the year is 3% of book value. The depreciation charge is to be calculated from the date of valuation and date of purchase. The total depreciation charge on vehicles for the year was €25,000. You are required to record on a tabular statement the effect each of the above transactions had on the relevant asset, liability and capital accounts and ascertain the total assets and liabilities on the 31st of the 12th, 2010. And that there is 100 marks. So again, you've got all of your assets up at the top of the tabular statement and all your liabilities down the bottom of the statement. So you can see this is 100 marker questions. So they just have more transactions, more months with transactions in it for a 100 marker question. You will be given paper similar to this in your exam. So step 1 is to lay out your tabular statement. So you can pause the video here and you can see how I've lifted the figures from the question and put them into the tabular statement. Okay, so step 2 then is to start doing the actual transactions. So let's read January. So Moore Limited decided to revalue land and buildings at €700,000, which includes land valued at €90,000 on the 1st of the 1st, 2010. So up here we see our buildings €550,000. If we're going to revalue them to 700,000, we need to add €150,000 onto that. Now you'll see that we have also unwound the depreciation that had previously been charged on those buildings, 550,000. So we've added 11,000 back in there. So total assets, €161,000. And that will go into the revaluation reserve in the liability. So if you think about your question 1 in your finance by under capital and reserves, you have your revaluation reserve in there whenever you revalue land and buildings. Okay, February. It says Moore Limited bought an adjoining business on the 1st of the 2nd, 2010, which includes buildings, 200,000, equipment, debtors, and creditors. The purchase price was discharged by granting the seller 180,000 shares in Moore Limited at a premium of 20 cents per share. Okay, so we put the 200 into the buildings, we put 30,000 into the equipment, and we put 8,000 into the debtors. Then we move on and we put 40,000 into the creditors in the liabilities there. The purchase price was discharged by granting the seller 180,000 shares in Moore Limited at a premium of 20 cents per share. So we check the balance sheet and we look and see how much each share is. And each share is €1. So that is share capital there, €180,000 at a premium of 20 cents per share. So 180 by 20% is €36,000 share premium there. So at this stage, all of our liabilities are €256,000. So our assets as it stands, 238,000 is not the same as 256,000. So there's 18,000 difference. So that is goodwill. So what is goodwill? Goodwill is the established reputation of a business. It's an intangible fixed asset. So when Moore bought this other business, it obviously has like established customers and good footfall coming through the business, etc. Okay, good trade. So that is an intangible fixed asset, so €18,000 is goodwill. April then, management decided that the provision for bad debts should be raised to 7% of debtors. So you have to remember here that your debtors, it's not just 80,000 anymore, it's 80,000 and 8,000, so 88,000. So 88,000 multiplied by 7% is €6,160. So that is the new bad debts provision. What it has at the minute is €4,000. So 4,000 plus 2,160, all right, is our 6,160. Sorry, there should be a bracket around that 4,000 there. So that should be a minus. So that 4,000 is taken away from 80,000, so that's minus 4,000. So we have a further minus 2,160. So that is an increase in bad debts provision. And where would we put that in question 1? In question 1, we would put an increase in bad debts provision into our expenses, our selling and distribution expenses. So that reduces my net profit figure. So I put it into my profit and loss account and I reduce the profit minus 2,160. So I've got minus 2,160 in both. In May, we have a vehicle which cost €25,000 was traded in against a new vehicle costing €35,000. An allowance of 20,000 was made for the old vehicle. Depreciation to date on the old vehicle was €5,500. So what we do is we go and we change the cost of the vehicle. So here you can just add 10,000 or you can minus 25,000 and then add 35,000. So you can put the two figures in or you can put just the €10,000 here. So the change between the one that was sold and the one that was bought. Now, when we sell a fixed asset, we are going to get rid of the depreciation that was charged on that fixed asset because we no longer own it. So the depreciation to date on the old vehicle was 5,500. So we're going to, from our minus 20,000 there in depreciation, we're going to add 5,500 back in. So that is 15,500. Now what we want to think about now is how did we pay for this van? Well, the new van cost 35, we were given an allowance of 20, so what's the 15 difference? How did we pay for that? Well, we obviously must have paid for it out of the bank account. So we put 15,000 here. That is not a minus, it's a plus because this bank figure is an overdraft. So this is already a minus figure. So 24,000 in minus, and I'm going to add another 15,000 minus, so another 15,000 is coming out of the bank account. Now, I have 15,500 up here, but I've only the 15,000 here. First of all, where's this 500 coming from in the P&L? Well, we obviously made a profit on the trading in of the old fixed asset. Why? Let's have a look. So the old vehicle cost 25 grand. The depreciation on it to date was 5,500. So that is a net book value of 19,500. And we were given an allowance of 20,000. So we were given more than what we thought it was in our books. So that is a profit of €500. So profit going in there. So we've got the same figure in our assets and liabilities, which is what we want. Moving on then to June, to our bank month, it says received a bank statement on June the 30th showing a credit transfer received of 4,500 to cover 9 months rent in advance from June the 1st and a direct debit of 1,500 to cover advertising for the year ended 31st of the 3rd 2010. Okay, so now I want you to know straight away, first of all, that the date that the bank statement was received means absolutely nothing. It has no relevance whatsoever to anything that we're going to do here. We receive a bank statement, we could have transactions that happened 6 months ago on it. Okay, so forget about the June 30th there. So we'll look first of all at the two amounts and let's see how they are going to affect the bank. So here's the bank overdraft here. Received a bank statement showing a credit transfer received, so money received to cover 4,500 months rent in advance from June the 1st. So that's 4,500 money in. So in the bank there, we say minus 4,500. So that is the bank minus there. And a direct debit of 1,500 to cover advertising, so an expense paid. So an expense paid will increase the overdraft. So that is plus 1,500. And so what we need to do now is figure out, well, as well as putting them in the bank, where else do I need to record these two figures? So what we need to do is we need to decide, what are they? So if we think about the 4,500, first of all, that is to cover, and that was received, by the way, that was 4,500 received to cover 9 months rent receivable in advance from June the 1st. So if we want to count the months there, we have June, July, August, September, October, November, and December. So that is 7 months rent received. So 7 months rent received for the current year. So that means there are 2 months rent receivable prepaid for next year. So that is a current liability. So here I have rent receivable. Sorry, that word should be out a little more. Rent receivable prepaid. So the 4,500 will go in here. And the direct debit of 1,500 to cover advertising for the year ended 31st of the 3rd 2010. So we are doing the year 2010. So if we're covering advertising for 3 months of this year, there was obviously 9 months that was due at the start of the year. So at the start of the year, we already had 9 months advertising the expense, but we hadn't paid for it. Okay, so that is expenses due then. So the 1,500 will go into the expenses due, and we'll take that away because it's reducing the amount of expenses due. So that is the June column, and as you know by now, having had plenty of these done already, we will have a December column that is going to relate to our bank adjustment. So what we want to do here is say, well, how much of these items relate to the current year? Like how much rent receivable relates to the current year, and how much of the advertising relates to the current year. So if we look at the advertising first, the advertising was 1,500 for 12 whole months. But how many months related to this year? 3 months related to this year. So 1,500 multiplied by 3 over 12 is 375. So 375 relates to this year. So I put 375 into the December column. Now, what does €375 advertising paid do to my profit figure? Well, it reduces my profit figure. So from my profit figure, I'm going to minus €375. Then we look at the rent receivable. So earlier on, I worked out that 7 out of the 9 months relate to this year. That's the rent for this year. So 7 out of the 9. So 4,500 multiplied by 7 over 9 is 3,500 euro. So from our 4,500, we're going to take away 3,500 euro. And we're going to have then 2 months prepaid at the end of the year. So 4,500 multiplied by 2 over 9 is 1,000. So that is rent receivable 3,500, and think about what that does to your profit figure. So into our profit, we are going to add 3,500 profit that we would receive. So that is June done. Then we have July. So a payment of €720 was received from J. Murphy, a debtor whose debt had been previously written off and who wishes to trade with Moore Limited again. This represents 80% of the original debt, and the debtor had undertaken to pay the remainder of the debt by February 2019. On the same day, goods to the value of €440 were sold on credit to Murphy. So let's look, we'll take the first paragraph first. So payment of 720 was received from a debtor. So 720 is going to go into the bank. If money comes into the bank, that is going to reduce my bank overdraft. So I minus €720 from here. Now, that €720 represents 80% of the original debt. So they have promised that they're going to pay us the other 20%. So 720 divided by 80 multiplied by 20 is my €180. So they've promised to pay us that back. So that's going to be added there. Now, when we have a bad debt recovered, we record it in add operating income in question 1, as it is money coming back into the business. So we want to put the entire 100% into the P&L account. So the 720 divided by 80 multiplied by 100 is 900 bad debts recovered. So there goes in there. Okay, and then it says on the same day, goods to the value of €440 were sold on credit to Murphy. So what we're going to do there is we're not told anything about profit, markup or anything like that. So we just have to assume that we sold to them at cost price. So from the stock, we take away the €440 and to the debtors, we add the €440. So both your assets and liabilities then have €180. Okay, August. Goods previously sold for €600 were returned. The selling price for these goods was cost plus 20%. A credit note was issued showing a deduction of 5% of the selling price as a restocking charge. Okay, so goods previously sold for €600 were returned. Selling price of these goods was cost plus 20. So €600 is €120. Therefore, cost price is €500. A credit note was issued showing a deduction of 5% of the selling price as a restocking charge. Okay, so what we're going to do, we're going to add 500 back to the stock. So 500 is the cost price of the stock, so 500 back in there. What we're going to do from the debtors is minus the amount of the credit note. So the credit note was for the 600 minus the restocking charge. So 5% of 600 is €30. So therefore the credit note given to the debtors is the full 600 minus €30 restocking charge, which is 570. So the debtors are reduced by 570. Now, we are going to reduce the profit by 70. Now, previously, when the goods had been sold to the debtor, the company were making €100 profit. So the selling price was 600, the cost price was 500, so they were making the €100 profit. But we're not reducing it by €100. Why are we not? We're not reducing it by the €100 because we have charged a €30 restocking charge. So therefore, our profit is just being reduced by €70. Okay, so that is August complete there. We've got minus 70 in assets and minus 70 in liabilities. In September, A creditor who was owed €800 by Moore Limited accepted equipment, the book value of which was €700 in full settlement of the debt. The equipment cost 1,200. Okay, so the creditor was owed 800. So we minus the creditor by 800 because they accepted equipment in full settlement. So how much was the equipment? The equipment had cost 1,200. So we minus 1,200 from the equipment. When we sell a fixed asset, we get rid of the depreciation that was charged on that fixed asset. So the depreciation charged here, the equipment cost 1,200 and the book value was 700. So the depreciation charged was €500. So we add that back in because minus the depreciation was minus 1,000 there. So therefore, we have to add it back in to unwind it. So that's minus 700 there. Now we have the minus 800 in the creditors. What is this €100 here? Well, that is obviously a discount received. The creditor was owed 800, but they accepted something worth 700. So the difference is a discount there, €100. Now, moving on to October. Dividend of 5 cents per share was paid on all issued shares. So, what were the issued shares? 440,000 plus 180,000. So, that is 620,000 multiplied by 5 cents or multiplied by 5%. That's €31,000 that is going to be paid in dividends to shareholders. Where is that 31,000 going to be paid from? It's going to be paid from the bank. And so the bank overdraft is going to be increased by €31,000. Now, what is going to happen? Where else am I going to put that? It's going to come from the profit and loss account, because when we take away dividends from our profit, obviously our profit and loss figure, our very last figure in the trading profit and loss, is going to be reduced by 31,000 because we've paid those dividends. So that is October done. In November, it says received €100,000 from the issue of remaining shares. So we have here 440,000 and 180,000 shares already sold. So that is €620,000. So what we have to do is we have to look at the authorized shares in the balance sheet. All right, so the authorized shares in the balance sheet are €700. So we can only sell 80,000 more shares at €1 each. So you can only issue 80,000 more shares. So what must the other 20,000 be that from the 100 grand that you've received? Must be share premium. So you have to be very, very, very careful about that. You need to look back at the balance sheet and make sure you know how many authorised shares there are. And that money came out of the bank, came into the bank. Money came into the bank, so that is going to reduce the bank overdraft. So from the bank, we have minus 100,000 there. So we've got 0 and we've got 0. And that's it for November. Then we've got December. The building's depreciation charge for the year is 3% of book value. The depreciation charge is to be calculated from the date of purchase and the date of sale should be. The total depreciation charge on vehicles for the year was €25,000. Okay, so going back to our land and buildings, we revalued them at the start of the year to €700,000, but I would have asked you to underline that the land was worth €90,000 and draw a line down to your December transaction where you were asked to do your depreciation. So 700,000 minus land 90,000 is 610,000, multiplied by 3% and multiply that for the whole year because that was revalued in January. So that's 18,300. And then in February we have €200,000 multiplied by 3% multiplied by 11 over 12. Why is it 11 over 12? Well, it was only February, April, May, June, July, August, September. So it was only 11 months. So we had that for, remember when we bought the adjoining business. So that is 5,500. So 18,300 and 5,500 is 23,800, which is our depreciation from the year which is minus because we are taking that away from the land and buildings. Now, 23,800 depreciation will reduce my profit in my trading profit and loss, and then down here. So I minus 23,800 there as well. And then it says the total depreciation charge on on vehicles was 25,000. So from my vehicles, I'm going to minus a further 25,000 here. And depreciation on vehicles will also reduce my profit figure by 25,000. So that is minus 48,800. So that's it. That's December done. And that is your entire tabular statement done, apart from getting your 8 marks for totting up your final figures there. So you can pause the video now and just check that you have all of the figures going across and practice doing your final. So we don't know what figures or what marks that they are going to be going for, but more often than not, it's definitely marks for the P&L, the bank, and a couple of other tricky things. But that is the tabular statement